Jerome Powell came out today and let us all know that the stock prices appear to be fairly highly valued. And well, the markets didn't love that reaction, but we're going to talk about some of those indicators that suggest that it is overvalued. However, also we're going to preface this with that we are in a bull market, a stone's throw away from another all-time high. Can we see pullbacks? Obviously, and we need to prepare ourselves for what that might look like. Let's get into today's episode. All right, people, welcome back. I've shared this multiple times. It's the Buffett Indicator, where we look at U.S. stock market value to GDP. And this red line over here is a 2 standard deviation level and is comparative to the historical trend. What is it calling out right now? It just says that we're at some pretty elevated levels. You can go back a little bit prior to this, and this was right before the bear market of 2022. If you remember, prior to that, the Fed shot off their cannons and the market ripped all 2021, and we kind of came back into those levels. Prior to that, we had the dot-com bubble really get inflated there as well. So you can see we're actually outside of that 2 standard deviation level utilizing this specific tool. You can also look at combined trailing PE, forward PE, CAPE, price to book, EV, EBITDA, Q ratio, market cap. They're taking all of this information, and it says we're #1 overvaluation across the entire board. And you can see the last time we were at these levels, 1999, 1966, 1929. Crazy. Now we're starting to get indicators from Moody's saying that the probability of a recession in the next 12 months is right now at 48%. So it's not quite at 50, but you can see if we just look back to the left, these are times that we've had actual recessions in the market. You can go to cycle charts, and it typically tells when we might start to see a downturn or the best turn to buy in various markets. And I found this one to be very interesting because, this is from a farmer from like 1875. And if you look over here, this was the top there in 1999. Well, we all know that the dot-com bubble bursted. Over here, we had 2007. And that is kind of interesting because we went into the financial crisis. We had 2019 peak over here. And what was that? We went into the pandemic. And then now we're coming into the year 2026. So we're going to see potentially something, of a similar fashion. I couldn't tell you, but I will note that from 1999 and then 2007 to where we are now, you can also take a look at the, what the Fed was doing as far as rate cuts go, what the yield curve was doing, and what the market anticipated or what it did in terms of, movements after this. And you can see here, being that we're in a rate cutting cycle, we just cut it down 25 basis points. The yield curve will begin to steepen or uninvert, right? This is the 10-year 3-month. We saw this here happen in 2007, started to uninvert, 2008, and got it steepened, dramatically. We went into a rate cut cycle, same over here, boom, steepened dramatically. We cut over here, even in the pandemic. Yeah, you can call this a one-off, but we had this kind of squeeze higher, and then we went into the pandemic. This steepened, we cut rates, shot the markets obviously higher, and now saw the longest and deepest inversion, or one of the longest and deepest inversions in history. I think that this was the longest, but I could be mistaken. There could have been one other time throughout history. And then we're talking about cutting rates, driving rates lower. And well, if this starts to uninvert and steepen, is it going to be similar to what we've seen over these areas where we see it press higher to new highs, press higher to new highs, press higher to new highs, and then all of a sudden things kind of fall apart? Well, yeah, sure, maybe, potentially. And a lot of people might say, well, didn't we just have a 20% pullback? Well, yeah, in 1998, we did the same thing. We had a 20+% pullback over here, and then we ripped to new highs. So as we're kind of moving into this later of the cycle, we're talking, like you hear more and more talk about bubbles, overvaluations. Yeah, we got to be prepared, but we got to just do our best to how to navigate that. And if we just look at something like the SPY or the S&P 500, right, the SPX, it's in a bull channel, right? We're seeing a series of higher highs, higher lows. Yes, we had a down day today, but what does this look like in the grand scheme of things? It doesn't look like anything. A lot of people are saying we're squeezing here in September. Yep, September, we started the day down, the first day down, and then we ripped the rest of the month, and we're still within that channel. So we're up about, 2.5%, 3% on the month. And I did find it interesting that also, August, the first day was the low of the month, and then we went higher. And then the same thing goes for July. The first day was the lowest price point of the month. So for 3 months in a row, the first day was actually the lowest. So the last 3 months have been quite the squeeze here in overall markets. And we do have that bearish divergence forming, but we are still, like I said, holding within this bear channel. Perhaps if we get back under 6,600, we go to 6,500 and kind of see what may happen after that point. But like I said, yeah, things are frothy. If you look for pullbacks, then we got to start paying attention to systematics, gamma flip lines, etc., which we will discuss obviously today. We did see energy outperform the market today, and we've shown many times through history that when energy outperforms, it's not typically a good sign for the markets. You can look at this chart where energy outperforming the S&P 500 means this line goes up, right? So it just means that energy, right, from a relative basis is doing better than the S&P 500. And when that's the case, what do you see happen down here? You have green arrows pointing up. At the same time, you have red arrows pointing down. So if energy, right, starts to outperform, right, it could put a pause to the S&P 500's current rally. We saw a little bit of that today. We saw utilities up there, real estate up there, consumer staples. So it did feel more risk off focus. Really, it felt like this, because this wasn't a full capitulatory day, it felt like a day of rotations taking place in the market, kind of leaning off of tech a bit as the NASDAQ was down 95 basis points. Now, the two things that have been driving this market higher have been systematic flows, right? You can look at CTA positioning, and this is getting very, very frothy, right? We haven't seen this stuff since 2020, and you can see other prior times that we've reached to these levels. We've had pullbacks in the markets, but on the flip side of that, we were talking about what over here. We were saying, well, now CTAs, they could become buyers, right? Because the sell side could be exhausted, right? There's less and less sellers down at these levels. Well, there's less buyers from a CTA position at these levels. And what happened? Well, we ended up finding a bottom when we ripped. So when these programs start selling into selling, things can get pretty nasty. And the same thing goes for vol control funds. And you could see that vol control funds, right, dating back to the 2020, right, these are some very, very, very elevated levels. And as we hold above the gamma flip line, as there's a lot of liquidity above us and really below us, it's keeping the volatility suppressed in these markets. And if you want to know when volatility can explode, you got to really pay attention to this area, and it changes, right? It's dynamic, it's updating, but I'll look at it at the end of the day in the mornings. Gamma flip line is currently at 65. I'm rounding it up a little bit, 65.80, and this right here lets us know what dealers are going to do. So when price action is above this, dealers will look to buy the dip, sell the rip, buy the dip, sell the rip, and that's what you do. You get a lot of small up days, right? But when you're in negative gamma, or you're starting to go into negative gamma, or there's a transition taking place, you may have a big down day that wipes off 4, 5, 6, 7, 8, small up days. And we're not too far off, but the gamma flip right now is, it's outside of the weekly moves for the market, the expectations of the weekly move for the market, which is at 65.80. That's the weekly move, 65.80, 98 cents, 67.47 above us. Tomorrow's daily implied move, 6626, 6687. So that's what the market's pricing in as far as one standard deviation of risk. We did get up to that call wall at 6,700, and yeah, traders still continue to reach out further, but you can see as price goes up, what happens? Well, things get frothy, dealers will sell into that, and they're going to look to obviously buy the dip. So we got to just be prepared where the dip may potentially go. If we sell off, and it sells off dramatically, say for example, and we break through the daily EM, pay attention to the lower weekly move, and this white line is the September anchored volume weighted average price. It happens to be the September low, also because of the first day, like we already previously stated. So down in this area, if price were to come here, pay very close attention to this, because we have yet to test the September anchored VWAP. And sometimes the first tag of those, you can see the most aggressive moves from that. Now, I wouldn't recommend just buying into it. I would say look for strength from it, because you never know, right? It can slice through butter. We just don't know. And as the market's kind of pressing higher, we've been talking about breadth diverging. You can look at the percent of stocks above the 50-day moving average in the NASDAQ, right? That's been kind of going lower as the market's been pressing higher. The 200-day, right? That's been going lower as the market's been pressing higher, indicating that it's getting more narrow leadership in the markets. If we take a look at the bullish percent chart for the NASDAQ composite, we are building out a negative divergence. The market presses higher. RSI is getting to overbought. You have a higher high and a lower high right there. Technology sector for the bullish percent, it is now moving into that overbought condition, which is at 72.56. And we like to see if these bearish divergences play out, just like we were tracking the bullish divergences that caught this bottom. And it also helped us find and navigate a couple of pops right throughout here in the technology sector. Now, while this is all happening, we see gold continue to rip higher to another all-time high session. The RSI is very frothy. We pulled back a little bit, shot off a little bit more. Pretty interesting stuff right now taking place in gold. I don't know what this is pricing in or what the market quite sees, but I feel like it can become very obvious in hindsight. if there's all of a sudden some sort of a catalyst and we all go, oh, that's why it's going, which then if that's the case and gold reverses, right? Say if we have a big move up and then gold reverses, that could mark, could mark a period where you go through a consolidation that could last months or even longer. If we continue on, oil has shown some strength today. We saw a lot of energy stocks too, right? As we previously stated, show up today as well. One of the names that I enter on the live stream and also in the trade ideas section was Halliburton. And Halliburton, like I said, right, you look for stocks that are tightening up, that are coiling up, and when it breaks out, it offers up the best risk to reward. Well, Halliburton went up to like 8 or 9% today. So I took a little bit of profits off, and now I can leave some runners on and see what it does. So if oil starts to break out, yeah, we'll probably see some energy names start to show some strength or continued strength. If it starts to break down from this descending kind of wedge, I mean, perhaps, there's also something economically going on in the market that we have to pay close attention to there as well. If we continue on and we look at oil relative here to the 10-year yield, they kind of move in lockstep for the most part. They do have a strong correlation. And if oil continues to go higher, could indicate that the 10-year yield can head higher too. So it's important to know those correlations that these assets have with various other assets. And the 10-year yield, as you can see, since the Fed cut rates, it went down, and then it's been straight up since, just like the last time they cut rates. So rates are higher, but yet the Fed is cutting. Just an interesting dynamic overall in these markets. If we take a look at the Sailor to Shift tool, Bitcoin did, we had the sell signal, I believe it was right here. So this week came down across under, and then this week hit the low. And since that point, we flushed a little bit lower. We had mentioned on the video when that first initially happened that we can probably see some sort of bounce back up to kind of that value area where we saw a lot of price action at about 115,000 on Bitcoin. And we did, and now it's coming down a little bit. It's still on the sell signal, sell trigger. I haven't had a confirmation of this above it yet, but when it does, I'll let you know. And I will say that it is starting to point up, so that's positive. But let's see here. This has caught all the big sell side activity, right? We've caught this, these moves down here, caught this, this move over here, and it's been really good with catching buy side also as well. You have a couple of whipsaws here and there, but it's been a very, very useful tool for avoiding any big crash that has ever happened in the price of Bitcoin, and that's just measuring it to gold. So it's pretty useful tool here. Let's take a look at some of the expected moves. Last week we did not tag the expected move. I couldn't get a video out yesterday, so I'll just following up with that today. We did come up into the quarterly implied move and the month to date, but month to date was for the S&P 500. So these quarterly implied moves, this is what the market priced in, going into July, right? So for 3 months, 1, 2, 3, and now we're going to be moving into Q4 very soon. And we're kind of in, end of month. Could we see end of month markup? I don't know. But what I do find interesting is the last 3 months, like I said, the first day was the low of the month. So, and this was a pretty big down day. This was a pretty big down day. I wonder if it's going to hold true to that pattern. It'd be funny. So yeah, things are getting frothy. We're at these extended levels. We're coming into end of the month. Maybe we'll see some markup. Maybe we won't. As it stands right now, the SPY is still above a rising 5-day moving average, barely so. Today, right, this daily implied zone, we sold off into it, and we kind of held within it, and we closed basically right at that upper range of the daily implied zone and that quarterly expected move. Now, the updated one looks like this. So going into tomorrow for the SPY, if we start to sell off, this is what the market's pricing in beneath us. It's about 659 to 658. And remember, this is just one standard deviation of risk. And then above us would be back up to the monthly implied move, which is about 667 to 668, right into and around that range. And we are below now the week to date anchored volume weighted average price. So if we start to move up higher, just watch the direction of the week to date, because that could potentially act as a level of resistance, forcing price back down. If it comes back up like this, you'd want to see this start to flatten out, right? And then turn back up to feel more confident that, maybe this was just a little pullback before another rip higher. So yeah, it's a time to be obviously a little bit more cautious in these markets, but yet we are still in a bull market. Things from a larger term perspective, yeah, they're overvalued, but the reality of it is, that's where you make most of your money, is in bubbles, right? When bubbles are, blowing up, you don't want to just, let it go. You gotta be a part of that, trade what's working. And then when all of a sudden you start to see market dynamics shift, you can do kind of something that I do, right? I just reduce risk. So it lowers my portfolio volatility, and I only start to look for names that make sense and people might rotate into, right? And you kind of just see how the market ebbs and flows from that point. But that's all I got for you on today's video. Hope it helps out. I'll see you on the next.